Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome to the Risk Intel podcast. I'm Ed Vincent, and joining me today is the CEO of SRA Consulting, Michael Glotz. Michael, thanks for being back with us here again today.
That is great to be back with you.
Michael, during the first round of conversations on this topic of succession planning, we spoke a lot about best practices and included things like written job descriptions, identifying talent within your organization, the importance of cross-training and rotation, and backup plans for if you found yourself in a bind and needed to fill that chief risk officer role quickly. In this episode, let's build upon that and talk a little bit about some other topics: the regulatory angle, the investor angle, some of the consequences of ineffective or effective transition plans, and talk a little bit about success stories or lessons learned from some of the less successful transitions in the chief risk officer role.
Great. I'm ready to get started, Ed.
Let's move on to another topic here of where you're more likely to find a chief risk officer from a succession planning perspective. Are you more likely to find that person inside the four walls or outside the four walls? Because I think there's a case to be made either way. So maybe a little bit about the pros and cons of each of those.
Yeah, I would say if you're a bank of size, let's use a size of 10 billion in assets or more. You generally have enough staff, not only within the risk area, but across the organization, where you can plan to have your chief risk officers, and you can afford to have internal candidates as a chief risk officer. And so maybe identifying 3 potential chief risk officers internally, maybe people who are level down from the chief risk officer in the risk team, or people who run functions outside of that organization that have had broad background. In many cases, a chief credit officer of your organization may have had experience as a chief risk officer in another role, or I use the example of chief audit executive. It's really hard, when you look at banks under, let's say, 5 billion in assets, you're incredibly fortunate if you have an internal candidate in-house to be able to promote. And a lot of times you do, I think, and a lot of times the chief risk officer or the CEO makes a decision, hey, we're going to have a strong number 2 in-house, and we know we're paying a little extra money for this strong number 2, but our current chief risk officer is 63 years old, is planning to retire in a year or 2, and let's bring on that deputy chief risk officer who knows that they're going to move into the role. But I would say that's a rarity. I would say less than 10% of the time, if I would have had to guess, you have that person in-house that's been identified. Part of a succession plan in that case might be selecting an interim, chief risk officer for a period of time. If something happens where you need that person right away, let's say the person retires unexpectedly early or leaves to another job as in a better chief risk officer role, then you're under the gun to find that person. And it's really challenging when there's a gap in that time frame between when your chief risk officer leaves and a new one comes. We've all kind of seen it, highlighted in the last year with areas like Silicon Valley Bank. It doesn't look good for the CEO, doesn't look good for the bank, and in fact is maybe a root cause of some issues that were unexpected at the bank.
You're hitting on another theme there of transition or overlap periods that we haven't really spent much time on. But if you have to, particularly if you are looking outside of an organization, right, to your point that it's unlikely for smaller or medium-sized organizations to find someone that has that depth of experience inside the organization. And if you have to bring someone in from the outside, do you have a view on transition period and overlap periods and messaging to stakeholders and communicating to regulators? Kind of how much visibility should you provide into what's going on inside the organization?
Yeah, and there's been some really neat best practice examples, and one of them is Citizens Financial Group in Connecticut. They're a large financial organization, and John Griggs, who's the chief risk officer, is retiring this quarter. And John's well known in the industry and is a 34-year veteran of the banking industry and was with Citizens about 10 years. Well, they started looking last year for their chief risk officer. They found an EVP and chief credit officer from Fifth Third Bank, who's well known in the industry. And they, offered him a job to move to fill that role at Citizens Financial Group. Richard Stein is his name, and had a chance to work with Malcolm this quarter, and they're working together in that transition process. And of course, Richard has a strong background in banking, so they're not going to have to teach him, laws and regulations and how banks work and where the risks are. There's a lot of education there. Obviously, there's unique risks that every bank has that he needs to know and understand. But that's an example of a planned event, well done. You got the right talent, and in that case, Citizens with 500 billion in assets, you would think is big enough maybe to have internal succession candidates. But a really strong chief risk officer is a really rare commodity. To get one that is really additive to your bank, and they may have had a few people that may not be ready in the next year or two that need to continue to develop internally. And then that opposite issue, which was highly visible, that I just mentioned, was around Silicon Valley Bank. Wow, was that in the press? Not only the failure of Silicon Valley Bank, but the fact that their chief risk officer departed. Laura Izzaretta departed the bank. She gave a fair amount of notice, and before she departed, they weren't able to find a succession candidate. Had a gap, where there were some interim folks in the gap, and trying to fill the gap, and it was a reputational issue for Silicon Valley Bank that they had that gap without having a good bridge. And you can see the difference between an organization that is well managed from a succession standpoint and one that has a gap, and it just adds additional risk to the organization. So don't be Silicon Valley Bank in your succession planning process. And it is really important to probably invest the time, the effort, and really have that buttoned up. In today's focus, from a regulatory perspective, that's one area that when they ask you what's your succession plan, the answer should not be, I don't know. We don't have a succession plan. If you don't have a succession plan as a chief risk officer, that's a strike against you, and I think it leads to saying that you don't have strong management skills. If you haven't considered it, you don't have strong management skills. So that's one of my top 5 things, just in a bold fashion, to say if you don't have a plan to improve risk management, you don't have good management skills. If you don't have a succession, if you don't have a strong staff that you're developing and training, or at least on the plane, then you don't have strong management skills. That's one where you want to check the box to say, yes, I have strong management skills. I have I have a succession plan.
Right. So it's clear that investors care whether you have a succession plan or whether you have a vacancy in this role, as evidenced by Silicon Valley, or more recently, right, New York Community Bank, when investors, right, punished that stock as a result of some broader issues, but combined by the fact that it was identified there was not someone sitting in that chief risk officer chair at that moment in time. What's the regulator's view on this, right? You talked a little bit about, that whole concept of a strike against you. So is this a topic that comes up in the regulatory conversation? Is it something that the banks should be bringing up proactively? Are the regulators bringing it up? Can you just give us a bit of visibility into the regulatory aspect of this?
I think there's more and more focus on it. It's part of a regulatory checklist with heightened standards for banks above 50, because the chief risk officer has to have a talent management program, and succession planning is part of it. If they don't, then that's a check against them, to begin with. And by the way, with banks above 50 billion, the CEO needs a talent management program with succession planning. The chief risk officer is required to have a succession planning, and the chief audit executive. So those three positions are required to have succession plans for themselves and their staffs. And I would say to my board member friends out there, this might be a good time to take a fresh look at the succession plan for your bank. And especially in light of what's transpired in the industry over the last year, a lot of succession plans that I've seen, that make it up to the board are perfunctory. They were developed 2 years ago. There wasn't a lot of thought behind it. They're not updated routinely. And, succession planning is not like a one-time event. There's a continuous process where when you've identified succession candidates, then there's a plan to develop those candidates. So, that's a quarterly process to say, are they getting the right development? Are they progressing? Are they in a position where they're available today as a succession candidate, or are they a future opportunity candidate? So I would say to my board friends, this is a good time to really make that succession planning process, functional, not only for your chief risk officer, but for your CEO and their direct staff, and your chief audit executive as well.
Is there a minimum transition period that in your experience you've seen is needed, or is that really going to be very institution specific?
Yeah, I think it's institution specific, but I would say the more transition period, the better. And, probably kind of an ideal setup, Ed, might be a chief risk officer that has a deputy chief risk officer. And, maybe the deputy chief risk officer, has a lot of the skills and ability and knowledge, but not all the skills, ability, and knowledge. Because if they had all the skills, ability, and knowledge, then you have to pay them. There's an affordability issue, because those from experience, those really well developed chief risk officer, they're really pricey. You got to pay them. So you can't afford to have two, in I formation. But the ideal setup is having a deputy chief risk officer that has to learn and develop, that you're investing in. The longer the better. In the case of Citizens Financial Group, I think they had about 90 days of transition time. If you're bringing in somebody, like Richard Stein from Fifth Third Bank Corp, they're going to be able to hit the ground running pretty well. So a 90-day transition period, is a good amount of time. Sometimes it's about the optics, of the situation. A lot of folks can come in and have been around to be able to hit the ground running, but that transition period, there's some optics to that transition period where, if you have a person coming in on Friday and the other person leaving on Monday, you could, a lot of folks looking at that setup are saying, hey, was there a proper handoff? And, it's interesting that I was looking at a study of, if you look at basic risk in banks, the number one driver of operational risk is turnover of operational line managers. It's really that simple. It's like, hey, you have guys running the ACH and wire department, or gals running loan operations or deposit operations. They leave, they bring with them this wealth of knowledge, and there wasn't a good transition, and all of a sudden the place starts falling apart, or you're getting fraud, issues left and right. So the number one driver of operational loss events is that lack of succession planning in operations. And the same thing is true with the chief risk officer. Can you really afford as a bank to have a gap with your chief risk officer? I would submit, if I were a board member, the answer is no. And the same thing is true with chief executive officer. Can you afford to have a gap as a chief executive officer? I would say no. And that's why I think this podcast is so powerful, because it's a really good time to step back and really think the whole process again, given where we are today.
Michael, you hit on a number of, I think, really powerful themes there, from the fact that oftentimes you need to look outside an organization to build that into your succession plan. The fact that a succession plan is not a one-time event, that it requires continuous monitoring and development of candidates. It's not a set it and forget it situation. That having a meaningful transition period, 90 days or longer, if you can organize it, and the fact that this is an area that if it's not done well, and if there is a gap, then you are exposing yourself to additional risk, ironically, in an area that is supposed to be managing risk. And so it really feels like, this is the right time for organizations, whether it's board risk committees or leadership teams, to look at the succession planning topic and determine, right, what are the policies and programs you have inside your organization to manage succession within the risk department.
That's it, Ed.
Michael, thank you very much for your time here today. We appreciate you sharing these thoughts, really valuable and insightful. And hopefully we've given people some things to think about. And certainly, with SRA Consulting, you guys have some of the expertise that we talked about, from fractional chief risk officers to help bridge and mentor through some of these transitions, and also the experience of what it takes to find a great chief risk officer. So certainly, I know you could be helpful to folks if they have further questions in this area. So thanks for being here.
Thank you, Ed. Have a great day.